everybody, welcome to today's session, which is our last note for 2021. It's been a very busy year, and we've actually held on to this one for a while now, but Andrew's going to share with you why a little bit later. For those of you who are joining us for the first time, these are information sessions that are focused on an actual product that we're launching, and it's not the mechanics of how and why structured notes are able to deliver the returns and protection that they do. So for information on the mechanics, or if you want a refresher, just drop a message into the chat or contact us, and then we can set up a separate session with you. Also, please feel free, as Chad said, to drop your questions into the chat as we go along. And remember that Cashbox Global doesn't provide advice. This session is product information only and doesn't constitute advice. We always encourage you to do your own research and your due diligence. So with that, we're going to kick off, and over to you, Andrew.
Right. Hi, everybody. As mentioned from windy Cape Town, this has been a product that's a new note that's been very close to my heart. Certainly our counterparties, which are the investment bank in this instance, BBVA, as well as our structures, IDAD in the UK. I've been pestering them constantly, probably from about March of this year, to get ahead of the curve, to get into bed with an infrastructure style note. And I think what the prudent heads prevailed in terms of looking ahead in terms of what was going on in America. America, as you know, when it came out of the last administration, I think sentiment was very fractious between the various parts of the US legislature in terms of passing legislation. And, you know, even under the previous administration, under President Trump, they tried to build a wall, and that had a problem. But in terms of this particular piece of legislation, we wanted also to see whether or not it did get bogged down, you know, in the political arena. And that particular statement was generated on the 5th of November of this year, so not too long ago. You know, it was probably written for Joe, certainly in terms of, you know, making America great again, building America back, etc. But I think what is really, really important is that they have an opportunity to certainly reinvent what America used to be, which was a manufacturing, a logistical, and you know, production powerhouse. So it's taken a long time for us to get this product together. I think we've got the clarity of hindsight to now look backwards and see what happened to this infrastructural space during the course of 2021, which is quite interesting. And we certainly feel that, you know, the rationale that I'm going to take you through for the next probably 20 minutes, 25 minutes, is that this was a infrastructural bill that became law. It was passed effectively by all parties concerned, by both houses. So it's what's called a bipartisan piece of legislation. Everybody supports it. And it's this massive amount of money, $1.2 trillion, that is going to flow into an aging America with its aging roads, bridges, waters, you know, water system delivery systems, bridges, airports, railroad systems, and new projects. And to give you a flair for that 1.2 trillion, which I've told has got something like 12 noughts behind it, is spread into all these various sectors of the US fabric of infrastructure. And you'll see some new ones there. You know, it's not just confined to big civil engineering projects, typically roads, railways, and airports, you know, cars, planes, and automobiles. You've got power grid, which needs to be repaired, broadband, rolling it out, electric vehicle charging stations, you know, electrifying the new EV sort of surge that is going across the world. It's all very well producing electric cars, but it has an infrastructural support base in terms of going from A to B and having your car being able to charge your car at your destinations, ports, airplanes, etc. I think on the far left-hand side, quite interestingly, this is becoming one of the new sectors, you know, sort of looking over that wall of conventionality, cybersecurity, climate change. We've just finished COP26 in Glasgow. And interestingly enough, one of our companies that we've isolated in terms of our basket claims certainly, and it has been proved, that it is one of the cleanest manufacturers of its finished product, and we'll show you that. So there's a wide spread of funds that is going to be arriving into the infrastructure. And this is not a once-off sort of power surge, if you want to call it, or money surge. It's a scaled year-on-year rollout. I call it a long runway. It's not a short, tactical runway. This is a strategy to basically make America great again. So it's actually a very rare opportunity. I did some work and looking back, the last time there was major infrastructural spend in the States was something between 60 and 65 years ago. So we're going back to the first Kennedy administration, of the sort of scale on a ratio basis. So this type of spending just doesn't come along every day. So it should be seen, I won't say as an abnormal event, but it's an opportunity that should be grabbed with both hands. Similarly to what happened in COVID, the depth of COVID in February, March last year, that was an opportunity to secure great companies at blown out prices. And if you think about it, the US had lagged seriously. We're all very aware, 2019 especially, and into 2020, the tariff trade war between China and the US, it was debilitating. It was a tit for tat, and it was hurting companies on both sides, in both continents, on both sides of the equation. So America, realized that it's not going to become competitive through a debilitating tariff war. And in fact, these words this actual line has actually been précédé out of a speech made by the CEO of, again, one of the other companies that we've selected. So we've been very selective, if I call it that. A guy called Leon Topalian, who's the CEO of Nucor. He said this: the US had to secure its own safety. Looking through a lens, you're looking at safety, competitiveness, and becoming a manufacturer again, not just simply being made in China. So, there's still this undercurrent, but it had to reinvent itself and not use its aging infrastructure of factories, roads, delivery systems, logistics. It had to reinvent itself, and it had to spend a lot of money. Now, I find this point actually quite interesting. By nature, I like to listen to conspiracy theories, and I have my own. But certainly, this is a rollout and completion strategy that is non-negotiable. Economically, yes, because the previous points have actually sort of pointed to that in terms of America creating and cementing its station as the number one economy of the world. Just to give scale or a sense of context to the 1.2 odd trillion that has been allocated. The Chinese government over 2020 and 2021 has allocated and spent nearly 8 trillion. So they are very, very much in the frame of wanting to become the world's largest and leading economy. That last word, politically, why have we put that in there? Well, if one thinks about it, we've got Thanksgiving in the States tomorrow. The markets will be closed. And then they've probably got the most important day of the year, Black Friday, followed by Cyber Monday. Maybe from an economic perspective, I'm making light of it, but certainly politically, their next American election comes along in 2024. That's not too far away. Biden was inaugurated earlier this year, January, February. 21's flown past 3 years, and he will be up for re-election. Now, every sign points to the fact that he will not run for re-election, that the current vice president will probably be elected into that as a potential political appointment. So they need to deliver on this. That's why it's not negotiable. They need to be able to go to the mass US populace and say, we delivered economically, we provided this infrastructure, and this is money going into the markets. But what it means is that those companies become profitable, that it creates jobs. Okay, and the job focus in America this year, almost at every single opportunity, has been looked at very, very closely in terms of how many people are unemployed, how many people are resigning, how many people have been employed during that week or that month or that quarter. It's something that the Fed looks at very, very closely. So what makes us so positive about this play, about this opportunity? Well, every investment, professional, every investment opportunity will have a strapline says past performance is no indication of future performance. Absolutely correct. 100% I subscribe to that. But let's have a look at what happened to the space that is occupied by some of these companies that will be benefactors of this massive surge of cash into the American infrastructural space. So we call it yellow metal and steel, because these are two prime areas, two prime sectors that actually move across all those particular sectors that we highlighted originally. They're not specific or endemic to one specific sector. They right across. It's a bit like cement. It goes right across everything. You need it for everything. You need steel for everything, and you need yellow metal machinery to move it around. And certainly, if we take a proxy for what that whole infrastructural space has all been about, you take the Global X UTS ETF, you can pick it up on Reuters. This is a 1 year, pretty much this time last year to current. You can see what it's done. This is not a particular sexy sector. Okay, it's not a particularly sexy, if I can use that expression, ETF. There's far more exciting new age, tech, digital space, cybersecurity, you name it, biopharm, nanotechnology types of ETFs. But this is a sort of a bellwether of how the economy is actually doing. Okay, this is very cyclical. In other words, companies who operate in this space are reliant on the health of the economy, as well as the raw components and the materials that they actually use in that. So in the narrative here, there's a little bit of economics 101. Revenues do ebb and flow, and it's dependent on the health of that economy in which they work, in which they derive their revenues, as well as certainly the raw material, the commodity prices. Clearly, if you've got high commodity prices and you've got a very, very strong economy, well, then you're off to the races. But certainly, again, the second line there, you'll see the vast amount of expenditure is not something along comes every day. This is a rare event. We've said it before. It needs to be looked at, needs to be addressed. It needs to be taken opportunity. The opportunity needs to be taken. And there's that long runway. You've got that spending that's going to be phased in over a long period of time, in tandem, probably, I believe, with the next election, to ride that ticket all the way in to say, we delivered. We've made America, well, maybe not great, but we certainly delivered it from where it was, and what needed to be done has been done. It'll be a great election opportunity for them to capitalize on. If you can go ahead, Angel. So we could have chosen an ETF. I'm not sure if Graham McCallion from IDAD's on the call, but certainly I've been bothering him. I've been bothering the structures, the investment banks.
I'm here, Andrew. Yeah.
Hello, Graham. I'll introduce you formally just now. But
sure. Sorry to interrupt there, but I can definitely say Andrew has been badgering me for quite some time. So, so this is definitely a Cashbox Thoroughbred note, which is Andrew's brainchild. So well done.
So we decided, did we go for unknown companies where maybe some of the pricing hasn't been priced in? Did we look at a series of ETFs, electronically traded funds, iShares? What do we look at? And eventually, at the end of the day, we decided, because there's this wall of cash that's going to be arriving in this space, the titans, the big boys, are going to get the lion's share. They've got the infrastructure to take on the orders and deliver. They've got the manufacturing capacity, and they've got the delivery capacity. They've also got very long lineage. That was something we looked at very carefully. So certainly household names, some of these are certainly household names, we'll take you through them, were looked at very carefully. But in all, they're pretty much leaders in their sectors. And as I mentioned, this is not a go-go sector. This is not a sector where you make 30 or 40% in a week or a month. These are, as I mentioned, it almost runs in tandem with how healthy is your economy. But just take it back one step before we go ahead into the companies. The paymaster is a clear mandate. The paymaster is the US federal government, and there's a very clear plan, and it's non-negotiable. So they are hell-bent on getting this right. So we best, if you're an investor, have exposure to this. just bearing in mind, I always say this, these are companies that are reference companies. You don't own them. This is the reference underlying story. So here's the first one. Caterpillar, with its iconic yellow machinery that's all over the world. Obviously it's got a fairly large market cap. It's a Fortune 100. It's a fantastic company. It's been going, a long time. 1933 it paid its first dividend. And a little interesting story here. Caterpillar is part of a very unknown index. It's known as the S&P 500 Dividend Index, Aristocrats Dividend Index. Basically, what they've done is that they have paid.
Sorry, Andrew, I think Chad was wanting to say something.
Oh, okay.
No, I didn't say anything. It wasn't me.
I thought it. I heard somebody. Anyway.
Not a problem. So basically, what I'm saying is they've paid a cash dividend every year since the company was formed. Okay, that's quite unusual. And in fact, over the last 28 years, they've paid a consecutively greater dividend
Blue Velvet
every quarter.
Or Velvet Blues, and I haven't done any research on it yet, but I'll get to it probably only tomorrow. But
Chris,
I'm just doing the versus stuff now.
Chris, could we ask you to jump onto mute, please?
Okay. So CAT has, obviously, it's a worldwide company headquartered.
Yeah, I'll send him an email, give him a heads up. It's probably going to be Friday that we want him to.
Joel, I think you can mute if you're the host.
Yeah.
Sorry, guys.
The change is not immediate, but the change won't.
At least he's not being rude.
Yes.
Interestingly, it's a worldwide operation, Caterpillar. I, in fact, about 7 or 8 years ago, was in Staffordshire in the UK, and I went past the CAT head office in Cannock in Staffordshire. Well, I thought I was back in Deerfield, Illinois, which is their US head office. There were American flags everywhere. I mean, it was unreal. There was odd Union Jack, but it looked as though a little piece of America had landed in the UK, and it was quite overwhelming. So certainly in terms of its presence, in terms of its size, Caterpillar, I think because of that, is certainly a company that we had to include. And I'm very proud to say that its Caterpillar is also a constituent member of the Dow Jones Industrial Index. So that's 30 of the best price-weighted companies in the United States of America. So that's very prestigious. So where's its competition? Deere & Co. Most of us probably know it as John Deere. The good and famous green and yellow tractor, farm equipment. And you can see a little deer, if you look closely, under the pneumatic pipes on the front end of that yellow metal machine. And here's another piece of file 13 nonsense, which I tend to pick up a lot. If any of you on this call today ever come across a badge, a piece of metal, a sign of John Deere, the leaping deer, and the deer only has 3 legs, snap it up and buy it, because that was pre-1930. And after that, it assumed 4 legs. The designer said it better have 4 legs. But apparently those 3-legged deers are really, really expensive American memorabilia collectibles. So moving on. John Deere, again, has made a very, very successful transition from certainly it wasn't forestry, it wasn't agriculture, but into the construction space. And if anything, John Deere and Caterpillar, both on the automation side, are well positioned to fill those orders right across those industries. I think moving ahead, Jill, into the next, which are probably names that might not resonate so quickly with everybody on the call. United States Steel, US Steel, Fortune 500 company, second to the largest US steel company, which we've also got in the basket, Nucor. I think quite interestingly, and I talked about lineage earlier and history, this is a company of over 100 years old. So its original germination was made by 3 individuals who are quite synonymous with the US, with the US business world. So the three main founders of US Steel were Andrew Carnegie, Charles Schwab, and JP Morgan. They always had other business interests, but this was one of them. So certainly it's the second largest and probably the largest scrap reproducer in the United States. But, you know, that photograph, you start getting a sense of the urgency, the sense of production rollout and delivery of product to all those sectors. Again, it's a company with a 100-year lineage. And certainly they steel products in terms of their fabrication is going to be used all over the show. And then the final company, Nucor, again, these are companies that are not sexy. They're not NVIDIAs, Apples, and Teslas. But again, listed on the S&P 500, Fortune 500 companies. So the pedigree and the integrity of these companies is there. Long lineage, great management. This is the largest steel producer in the US and also the biggest recycler of scrap. Quite interestingly, and I don't know if this is a good thing or a bad thing, depending on which side of the labor equation you come from. But in my research of the company, it's it has a labor force of something like 7,000 people. And one of the prerequisites of joining is that you may not be a union member. So in other words, it's worked on the basis of you don't have a union. Now, America is very unionized. It's highly, highly unionized. The labor market is very, very complicated. But bless you, very, very complicated. And that's quite an interesting fact in terms if they want complete rollout with no strikes or no interruptions to delivery, that's probably could be quite a useful factor in its favor. I think Nucor, if you cast your mind back to what the angle of that chart looked like in terms of the ETF, Nucor is a component of that, a very large component. Nucor's share price from March last year, at the bottom of the pandemic, has probably risen fourfold to date. So I was frustrated, as I mentioned, when I introduced Graham to a little degree. I said, let's get onto this thing. And the question I've been asked is all this growth priced in? Have we seen the best of it? Are we buying something that's now just going to go sideways? Well, as you know, a structured note is more of a bearish instrument. It's not we're not out and out growth. We've got protection built in. We've got defined returns. We've got defined growth and income in this particular product. It's a hybrid. It offers both. So it's the best of both worlds. I certainly see it. And moving into this, let's just expand that a little bit more. Your capital protection has to be by an investment bank that is both a tier one and ticks all the boxes in terms of the credit rating agencies right at the top. BBVA is a multinational, primarily Spanish global bank, very, very strong in this particular space with very, very strong relationships with our counterparty structure, I'd add. And it's been quite difficult. I can tell you this from the bottom of my heart. It's been quite difficult as this year has progressed to create coupon values that are into the double-digit space, simply because what we have seen during 2021 is a great amount of growth and a great increase in company valuations. So the banks, get to a point where they're not falling over themselves to buy options to acquire these shares at a point in time. But in these particular companies, they see slow incremental growth, following that sort of curve or that chart we showed via the proxy ETF. They've managed it to only 4 years. So there's a maximum term of 4 years. They can't go longer. We can't renew it. However, it can end earlier, and we'll take you through that. The coupon is there. It's US dollars only. I mean, this is a homespun US product. I think the only component of non-US sort of taint here is the fact that it's not a US bank. It's not a Goldman Sachs or JP Morgan or Citi. It's an true international global bank. And those are the coupon values. So you have a coupon for both growth and income. Chad, I think, is going to not rush us through, but take us through and remind us how that works a little bit later. Order call trigger. So in order to get the coupon, the growth coupon, we need to be, those 4 companies need to be at their start price or greater, starting at 12 months and then quarterly thereafter. So many of you on the call understand that. The reference basket, we've been through those companies. And if I may just say on the rationale of those companies, as well as what I spoke about in our rationale, there is a rationale document on the website that you can access. It's got a much deeper dive into the actual thinking, the theorizing, the good, bad, and the ugly of why this product actually makes sense. Capital protection, important, because this is a key of every product we have put out since Cashbox has been in existence. We want our income triggers to be as low as possible, and we certainly want our capital protection to be as great as possible. So in other words, capital protection, what it means there by 50% of initial value is that those companies, those Fortune 500, Dow Jones, S&P, I've been through it and I did that for that reason, they would have to more than halve in value at the very end point for capital be at risk. During the term, it's fine. But if at the last observation, one of those companies, let's say CAT, halved in value, there's major problem with the infrastructural build. I think there's major problems with the world and the US then. Certainly, I'd like to take you to availability. We were very lucky to hedge this product. As I said, the banks aren't falling over themselves at the moment because the cost of money could be high for them. But we managed, and kudos to Graham and the team on the call today. They managed to squeeze out, being I think, ingenious in terms of splitting it between the two components of growth and income. But the allocations aren't huge. In other words, we have a limited tranche. We don't have $5 or $6 million worth left. It's literally going to be getting down to a situation of, unfortunately, and I hate to say this, first come, first serve at a point in time. We've got a little bit of wiggle room. Obviously, the terms and conditions, because this is a contract, there is a final date that we set in stone, and that's the 14th of December. Or if we use up all the inventory beforehand, that's it. We'll close the book on the raise. So that's pretty much the sort of terminology of the actual coupon of the product itself. I think if you want to take us on to the next, I think it's the fact sheet that came out last night. You've probably seen, you're probably used to this, many people. It's the co-branded fact sheet. Basically, product facts and features in the middle, key information on the right. I think let's concentrate on that today. Subscription period, which has been through, it could end earlier. The strike date, in other words, that's when they allocate the prices of to those companies. On the closing date of business on the 16th of December on the New York Stock Exchange, those will be the set prices that we would need to track going into the future. Issue date's just another word for start date. That's when it actually kicks off and gets going. So your first income observation is actually in March. So these years seem to fly past for me. It's only 3 months away, really, 3 or 4 months away by the time we got going. And the first auto call opportunity, in other words, the first opportunity for this note to mature is 12 months' time. Now, if it does mature, you will have picked up all those previous coupons. I think I'll leave that to Chad to talk about the growth coupons. You'd have been paid your quarterly income coupons, but then on the 16th of December next year, you'll pick up the 4 growth coupons per quarter. This is, I always say it's the simplest chart, but it's easy to understand. These are contractual terms set in stone. They don't change. You've got your various observations, quarterly observations. You've got the dates, the payment dates. It's normally a week later that it leaves the investment bank for your platform. So the first one is 16th of March. The investment bank would pay it to your platform on the 23rd, give or take a day or two for it to arrive there. The income trigger for you to generate those coupons, as long as the prices are within 50% of their starting price, that strike price we determine on the 16th of December. Happy days, your coupon is paid. And you can obviously, the first 3 quarters, there is no order call opportunity. That first one is on the 16th of December. So the 16th of December, you could pick up all those accumulating. I call it a snowball or a deferred kind of bonus. If it did order call on the 16th of December, you'd be paid those 4 quarters capital growth. You'd have picked up the 4 quarters of income, and the investment ends, and your capital is repaid on the 23rd of December to your respective platforms. So that's really your milestones leading out into the future, into the 4 years. If it did have to run right the way to maturity, that would be the 16th of December 2025. There's your 4-year sort of runway, if I call it that. So that really, in a nutshell, is the product. As I would certainly say, have a look at the rationale, dives a little bit deeper. Graham, before we go into the mechanics, is there anything I know you've been intrinsically involved in my beating the drum, but is there anything you'd like to add in terms of, so Graham is with IDAD, they structure the products, they have a very close relationship with the investment bank through the trading teams. They do the modeling, the software modeling, in terms of the payoffs of what we can squeeze out of the bank. So a lot of the products, in terms of the actual payoffs and the T's and C's, come out of this good man's hands. So I don't know if there's anything like, and we're really lucky to have you on the call. Thanks for coming along.
No, thank you, Andrew. I mean, once again, I have to say, you've well, first of all, hello everybody. But certainly, once again, Andrew, you've very, very clearly defined the thought process on this. It's it's quite a credit to you to have identified these. The stature of these businesses that we've included in the basket here of this note. I think you've covered most of the points. I mean, there's a couple of issues that, or a couple of points that I'd like to add, if I may, and that is just a couple of snippets of information. You spoke about the concept of the movement in the prices of late with some of these stocks, and it has been quite considerable. And the general feeling is, certainly with regards to institutional money, what we call or as deemed to be in the past, the clever money, would normally see this growth and then effectively sell, and what they horribly term as burning the later money that comes in, and so therefore make their profits and take it and go, and then we see the share price go down. We're seeing a massive shift in the change to this approach. And that's principally because the retail investor now, particularly in the US, is putting their money where their country is. And we're seeing swathes and swathes of cash that's coming out of bank accounts that is going into these stocks. The American people now are buying America. So it's not just the Americans. Obviously, as we know, it's a global exchange. Whether you call it the New York Stock Exchange or the FTSE or the JSE, it's a global exchange. Everybody participates, but without doubt, we are seeing a massive retail investment occurrence here. Everybody believes that this is now where America builds again. This is a phenomenal product. There's not only is it an opportunity to partake of exceptional growth in this specific sector, but the ability for the Senate approval for this monumental amount of money to filter into these businesses and start working and start generating capital growth within this sector will take about 12 months minimum. Again, with the way that we've worked with you with Cashbox, to be able to have that first maturity opportunity, that first call in 12 months time, just works perfectly with the market. So we are absolutely in sync. I'd add a couple of little snippets. There's 550,000 bridges in North America, and the American civil engineering body estimates pretty accurately that at least 10% are unfit for purpose. So that's 55,000 bridges minimum that will need either rebuilding or seriously repairing. And that's just bridges. So this money is going to be spent, and there are going to be Caterpillar machinery and Deere machinery and Nucor steel going into everything that is going to be required. Interestingly, as you absolutely correctly pointed out, Nucor is the largest steel builder in the US. United States Steel Corp is second behind Nucor. But the interesting fact is that their ability to be able to work towards this net zero as well has been clearly identified. So they're also absolutely, of course, encapsulating the whole climate change factor. So they are really, really geared up to participate in everything that's going on in the world, and specifically that's going on in America. So I think really to add to your, there's very little that I can add to what you've delivered there, apart from to say that I have not in a very long time, and I've been with IDAD now 7 years, I have not seen the ability to be able to pick up 12% per annum very, very easily in US dollars. It's quite a note to end on for 2022. So credit to you all. I think this is phenomenal. I really do.
Sure.
Okay, great. So what I'm going to do is just quickly run through a reminder on how the income component of the note actually works. So as you know, the underlying basket of stocks is valued at the strike date. So that's when they measure the date that the stocks are compared against at each quarterly observation. And it's the lowest performing stock that we track. And as long as the lowest performing stock is above the income trigger, which here is set at 50%, the coupon will pay out. We're talking about the income component right now. So as long as it remains at that point, it'll pay out. So for this example, say the market tracked and it dropped below the start price, but it's still above the income trigger, the coupon still pays. In the event that the coupon drops below that 50% income trigger, that's when the memory feature kicks in. And what it'll do, it'll hold the note, it doesn't lose the note. And the next time that the underlying basket is above that 50%, the memory feature will look back and pay out any missed coupons. So whether it's 1, 2, 3, however many have been missed, if it's over the income trigger, it'll look back and pay all of those out. And then at auto call, which in this case can only be looked at for the first time at the fourth quarter, you'll get that coupon as well. So you will have been paid all the coupons looking back up to that point. And to just remember that these notes are designed to auto call. They're not designed to run the full term. So 100% have auto call to date. And then just looking at the growth component of the note, in order for the growth portion to pay out, the note must auto call. For each quarter that the note passes, a coupon rolls up. So as Andrew was saying, he talked about a snowballing coupon. So it rolls up one more coupon. So by the time you look at the first observation for an auto call, you have 4 coupons that are rolled up. So your worst case scenario is that you will have received the 7.8% from the income component that pays out quarterly, and then you'll get the 4% from the growth portion. If the note doesn't auto call, that coupon just keeps rolling. So for every quarter that gets passed, another coupon rolls up. And then the auto call observation takes place every quarter after the fourth quarter. So the longer it runs, the higher the growth percentage, and then you obviously receive the income component as well. In terms of just a reminder how you access everything, first of all, each investment contract is vetted by all parties. So obviously we've been through it, Ardane's been through it for an extended, with a deep dive. The investment bank has looked at it. And then the last person that looks at it, other than your investment advisor, is the investment platform. And there was quite an interesting occurrence today with this. Andrew, do you want to?
Yeah, so normally investment banks, I always call it a bit of a belts and braces approach. Most of them are agnostic. They hold your ISIN referenced investment, whether it be a share in Harley-Davidson, Boeing, Nestle, your unit trusts, your investments like notes, etc., gold funds. But they hold it there and they do an agnostic job in terms of reporting to you in a sort of custodial manner. They like to have a look at the term sheets and the reference sheets to make sure that what they are holding for you actually is not something that's been concocted up in a wild frenzy. And normally they take their time about it. I must say we have some clients who use the Nedbank Private Wealth platform in the Isle of Man. They normally take minimum 24 to 48 hours. So either they had nothing to do yesterday, or they had a lot of spare capacity, but the note was actually passed within 3 hours. And I spoke to one of the administrators. They said when you're dealing with S&P and Dow components with a quality, A-rated bank, they know IDAD. IDAD have been an onboarded entity. They've been through all sorts of due diligence, so it makes that process a lot easier now. But it's great to know that sense of comfort that they're comfortable holding this type of instrument, this type of specific note, for clients. So that was great to go back to clients and say, right, we can book you in quickly.
Fantastic.
Cool. Thanks, Andrew. And then just a reminder, the investment runs from yourselves to your platform and to the investment bank, which is where the contract's held, and vice versa. Nobody comes between you and your investment. And the rates that are quoted are the actual rates. So 100% of your investment goes into the product. And then in terms of the returns, that is exactly what comes out. There's no deductions. And then with that, we're pretty much at the end. So if there are any questions, we can deal with them now. And if you're
I've got a couple, Jill.
Okay, cool.
No, I mean, seriously though, one question was put to me, and that was, when Andrew and I were talking about this, it was, at what level does Cashbox commit with regards a note of this ilk? And, Andrew's mentioned that there is a limited availability. There always is with notes. In the sense that we, and I won't bore you with the detail, but we have to what's called hedge a value, and that value has been hedged, and that is embodied within the contractual terms with the investment bank, BBVA. But what I would say is that, and Andrew's right to say that it's a first come, first serve, first come, first serve, because it most certainly is. However, we have a very strong relationship with BBVA, as in IDAD, and actually within the corridors of the business, Cashbox is being heard more and more. And so therefore, when we mentioned that this was a bespoke, a unique note that was being constructed for Cashbox, BBVA did say that they would look very favorably if participation was way beyond expectations. Now, I'm not opening the floodgates there, ladies and gents, but with regards to Cashbox and speaking with Chad and Andrew and Jill, there is a little bit of flex, but it is tight, and so therefore I'll say no more, and I'll let Cashbox manage that. The other point I'd like to make is that the actual strike date that we have and the parameters of subscription that the guys have laid out for you is very, very rigid. In the past, we've worked very hard with Cashbox to facilitate everybody being to get in different notes, but it really is very rigid now. And so therefore, when Andrew says the 14th of December, he means the 14th of December. And we can't bend very much more. Well, we can't, simple as. On the fact sheet, it does actually say the 15th, but I'd like to have a little bit of buffer on that. And I'd agree with Andrew and Chad and Jill that the 14th is the one to play with. As far as that is concerned, it's very clear. And I think the guys have once again, very eloquently displayed how this note works, what it does, what it can deliver for you as a wealth management proposition. And I certainly am very impressed with what they've done. So brilliant.
Are there any other questions from the floor we could help with?
Did a really good job.
Wow, well done, guys. Robert, would Glacier International have seen this, or do we need to put that up, do you think?
That's a very good question.
Actually, if you can get a copy of the recording, I think they would. The fact that it's IST, it's got an IST number and it's running through.
Yeah.
They're going to be quite comfortable. Yeah.
Okay, great. If you could let us know if they've cleared. And then Pierre's got a lovely question. If somebody's got the answer, how do we influence the currency? At the moment, we're struggling at 15.95 if you're in rands. Pierre, if I could solve that, dude, that'd be amazing.
Yeah, it's no, it's an interesting point, and I think I've heard from a couple of people as well that people are looking to sell sterling to get into this because it is only USD denominated. I mean, again, another interesting point, because we are seeing the dollar playing very strong against the pound at the moment, and so therefore, when iDad looked at this after speaking with Cashbox, we actually thought, wow, that's an interesting play, because it's actually, it could be a very, very opportune time to be able to sell out of sterling, get into dollars, participate in that fantastic return that's available, and then convert back, hopefully, when dollar, again, not certainly don't have a crystal ball, but may have gone the right way for buying back into sterling. But no, I certainly wouldn't want to play the FX game. No way. The fact that you can get 12% in a year with a split between income and growth on this note is enough for me.
Yeah.
Right.
Anybody else have anything? Amazing. If there are any other questions and you want to contact us offline or whatever, very simple, support@cashbox.global, or it's our first names @cashbox.global. We'd love to help out if there is anything. But otherwise, Andrew, great job. Thanks, dude. Jill, thank you. Graham, thanks for being here.
Pleasure.
And to our community, it's lovely to see everybody again. Anything you need, you know where to catch us. Alrighty. Have a great day.
Thanks so
everybody.
much, guys.
Thank you. Take care, everybody.
Ciao.
Bye-bye. Bye-bye.
Bye.
Thank you.